Well, hello and welcome to another in this video series where we're taking a closer look at the market strength indicator for NinjaTrader 8. And what I've tried to do throughout these videos is to really plant some seeds, some ideas of ways that you can use the indicator, not simply looking at it from the perspective of overbought and oversold, which is absolutely fine, and strength of trend as well, the steepness of the lines, where a particular market is in relation to the overbought, oversold regions, whether you're looking for reversal opportunities or jumping on a trend, but also to take it to a stage further, if you will, and really look at correlation of markets and those that perhaps do follow one another very closely, and indeed those that diverge. And in this video, I've moved to the bond market, which I know can be a little complex, a little confusing maybe, but within the program, certainly we've covered it in very great detail to explain all the relationships that exist there. What I've got here, I've moved to the slower time frames. So we've got the daily, the weekly, and the monthly, just the three there. And the futures that I've chosen are the 10-year, the 5-year, and the 2-year note. The ZN is the 10-year, the ZF is the 5-year, and the ZT is the 2-year note. And typically, you would expect to see these, generally speaking, following one another around. And in addition to that, we've also got the ES, because the ES, clearly, what we're looking at here are, if you like, the two extremes of risk sentiment. We're looking at high risk, if you will, in terms of equity markets, and we're looking at low risk, in inverted commas, in terms of bonds. So the sort of relationship that you would expect to see, to anticipate as a result of that, is money flow. If you think of it in terms of money flow and the risk of money, then typically what would you would expect to see, if stock markets are rising very strongly, that money flow must come from somewhere. And principally, it's likely to be coming from the bond market, which is an inverted commas safe market. Therefore, your money is flowing from safe markets into higher risk markets. And equally, when equities are falling, when the stock market is bearish, you would expect to see money flow in the opposite direction, coming out of stocks and flowing into bonds. And as the money flows into bonds, then as bond prices increase, then yields fall. That is the traditional relationship, and I guess the way people tend to view the two working together, which is typically, as I say, what you would expect to see. But in amongst that, of course, we also have to factor in the issue of interest rates. And at the moment, as at the time of recording this particular video at any rate, we have inflation, which is extremely high for many different reasons, which I won't go into at the moment, but they're unusual to say the least. And of course, as a consequence of that, interest rates have gone up dramatically over the last few months, and certainly in the last 18 months, to try and bring that inflationary pressure under control. Whether you agree with that concept from the central bank is open to debate, of course. But nevertheless, that's one of the few instruments they have to try and combat inflation, which in this case has been up into double figures, very unusual. Now, of course, how interest rates impact the bond market is that you will see once interest rates start rising, then the issuance of bonds will become more frequent, because as the interest rate changes, then new bonds will be issued. So the bond prices in particular markets will therefore fall. So it's not a very simple linear relationship between equity markets rising, bond prices falling, equity markets falling, bond prices rising, because you have to factor in the interest rate aspect as well, particularly at the moment. Now, what's interesting at the moment in terms of the daily, the dash line, I've just created as a dash line the S&P to make it more demonstrable, so you can see it very clearly. And we have our three bonds down here. And what's interesting here is we can see that at times we've got a falling equity market and we have falling bond prices here as well, as you can see. But what's interesting now is that we are seeing, yes, the stock market, in particular the ES S&P 500, is relatively weak. It's been in downtrend for a while. And what's interesting here is that we've seen this reversal in price for both of these futures contract, the ZF and the ZN. In other words, the slower timeframes, the 5-year and the 10-year, and they have started to rise quite strongly. And that's really suggesting that the market per se is starting to perhaps see an end to interest rate rises, and therefore they are trying to lock in higher, longer-term rates over here, which is an interesting phenomenon, which is what you would expect, because if interest rates are likely to fall, they've been going up very rapidly, and now there is a suggestion that they are peaking and unlikely to go much further, in which case you would expect to see money flow into the longer-term bonds to lock in those rates, if you will, which is what we are seeing more or less here. So that is an interesting facet, and it gives us a view also of interest rates, and we're starting to see the same on the shorter term here as well, on the 2-year. So as I say, when you look at these, when you study this relationship, you will see, and this is common to all relationships, all correlated markets, correlations come and go. They're not cast in stone. They do invert from time to time, and you have to accept that. As I say, the general view, if you like, in, let's say, in normal circumstances would be an expectation that bond prices fall as equity markets rise and vice versa. But as you can see here, this does change, and it's because it's being influenced by the aspect of interest rates. And we go right the way out here onto the monthly. We've had this decline, but you can see how, as we get to the bottom here, we start to see a pickup in bond prices here, but the ES is just starting to tick up. Because you can see how that relationship oscillates back and forth. So as I say, it's not cast in stone, but I just wanted to lay this out for you in this way. You can, of course, use this on an intraday basis, and in that case, you would expect to see that typical relationship between bonds and equities more closely followed in that particular scenario where you are down at the coalface on an intraday basis. But over the longer term, I've chosen here, as I say, don't expect it to see it is absolutely cast in stone. It won't, and it will be influenced quite heavily by interest rates, particularly at the moment. Now that relationship or that aspect of interest rate behavior will certainly calm as inflation comes under control, and very typical of the end of an economic cycle where interest rates have gone up very quickly because you've got a hot economy. Well, we don't have a hot economy at the moment. In fact, it's the reverse, and possibly going into a recessionary phase, not as a result of too much money in the market and an economy that's running hot. It's very much as a response to inflation that's been driven into the economies for lots and lots of other different reasons, which is unique and unusual. So when you apply this to the faster timeframes, typically that is what you would expect to see, and therefore it will help you on an intraday basis in really getting a grip on the view of sentiment, the flow of money. Are we in risk on, or are we in risk off mode territory? And as I say, that's really the point I wanted to get across here. Not so much the oversold, overbought, and the trending aspects of using the indicator, very much in using it to look at relationships with, and I'm sure that you will think of many, many others, and that's been my purpose in putting together this series of videos for the indicator. So I hope you've enjoyed this one. Thanks for watching, see you soon, and bye for now.